Hello everyone, welcome to today's US Open live webinar. It is Tuesday, September 5th, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. It's been an eventful day. Just in the wires, we had Saudi Arabia announcing that it will extend its voluntary oil production cut of 1 million barrels per day through the end of the year. And Russia did so with its own 300k export curb, and this boosts oil prices. Earlier in the day, we had the Australian Central Bank standing pat on rates for the third straight meeting, weighing on the Aussie. We also had poor services PMIs from China, Europe, and the UK. And there's a broader cautious sentiment in markets, which has led to significant demand for the greenback. That's what we will be talking about today. Quite a lot of things to catch up on. Before we begin, as always, read carefully through the risk warnings and the disclaimers, and then we'll start. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give it a few more seconds and then we'll start. Okay, let's get the ball rolling. We have Euro USD on our screens. So US markets come from a long weekend, so it will be interesting to see how the day will go as US investors return, and if demand for the greenback that we talked about will persist. Broad-based strength for the USD, but it seems a bit exaggerated for me at this point. We'll start with Euro USD. And we'll talk about the poor European PMIs. We're gonna talk about the Reserve Bank of Australia and the Aussie. Then we'll go to US oil and talk a little bit about the production cuts we already mentioned. And we'll round things off with the Nasdaq and with what's ahead as usual. So Friday's NFPs from the US pointed to a labor market that seems to be coming into better balance as unemployment jumped 3.8% and jobs gains were soft and wage growth eased. The report bolstered market expectations for a Fed hold and the view that rates have peaked. However, the US dollar is in demand on cautious mood, as we already talked about. Also, last week inflation ticked up and labor market is still tight despite those signs of easing. So there's definitely room for more hikes, and Chair Powell has definitely kept them on the table. At the same time, the ECB contemplates the economic slowdown in Europe, which was evident in today's poor PMIs. Services and composite for both Germany and Europe were not good, and highlight this divergence, we would say this economic divergence between the two regions, because the United States is doing much better in terms of economy. And of course, President Lagarde of the ECB has opened the door to a pause with a meeting looming next week. So what we have today is Euro USD extending its losses as a result of what we discussed. After 7 straight negative weeks, it's moving now into the 8th losing week. And as you can see, it trades well below the 200 days EMA depicted here by this blue line that we have talked again over recent sessions. If we switch to the daily chart, you can see that this is a technical level that has supported the pair multiple times throughout this year. Back to the 4-hour chart. So the pair is now exposed to the 1.0634, 10.611 region. You can see that the RSI points to oversold conditions, and as I said, the move seems a bit exaggerated at this point, given that markets don't expect another hike by the Fed. And on the ECB front, even though there is reason for apprehension by policymakers, they may have a hard time staying on the sidelines, given that inflation is moderating but is far from target. So we could see the pair already finds some reprieve, and we could see a rebound, but any such rebound will find an unhospitable upside, starting with the 200 period EMA, the black line here at around 1.09, and then of course the daily Ichimoku cloud looming, as we have talked again. So at this stage, bias is on the downside, immediate bias is on the downside, and strong catalyst will be required for a meaningful recovery past the black line here at around 1.09 and the EMA 200. Now let's go to the Aussie, as we had the Reserve Bank of Australia earlier today keeping rates unchanged at 4.1% for the third straight meeting and fourth hold overall in this tightening cycle that has produced 400 basis points since the May 22 liftoff. Inflation has passed its peak according to the central bank, we saw a deceleration in the recent monthly figures as well, further deceleration. The economy undergoes a period of below trend growth. The contracted by 0.2% Q-on-Q in the first quarter. Of course, we expect tomorrow the Q2 figures, and the labor market has shown some signs of cooling. The pair was already losing ground on this broader USD strength that we have talked about, and fell further after the RBA hold, and which sent it to new 2023 lows. You can see here the move, and exposes it to 0.6271. However, the RBA kept the door open to more hikes, and incoming governor had also cautioned for such possibility. We had talked about that last week, and inflation is not, despite progress, the inflation is not expected to fall within the 2 to 3% target for another 2+ years, and wages are historically high as well. And again, we're seeing here the RSI approaching oversold levels, so we can see some reprieve here in an effort to recover. However, the Aussie will need closes above the 200 period EMA, the black line here at around 0.6520, but that would daily close above this region would pose the upside, the downside momentum, but that looks like a tall order at this stage. Now let's switch gears and go to US oil. Here we are. So you can see this rising candle here, this boost that we saw just earlier, as Saudi Arabia announced the rollover of its voluntary production cut of 1 million, the most recent one of 1 million barrels per day for the remainder months of the year. And Russia also said it will do the same with its 300,000 barrels per day export curb. And of course, we have prospects for a Fed pause, and also China ramping up its stimulus over recent days, especially around the troubled property market, again, something we talked about last week. And US oil now eyes the next resistance at 90.36, but again, the move seems stretched. As you can see on the bottom of the chart, the relative strength index again being in highly overbought territory. So we could see a pullback here, and this move could also spark some profit taking. That would be reasonable. And as such, we could see a pullback here, but close below the 200 period EMA around $80 would need a strong catalyst. And of course, below that, from that level downwards, we have multiple roadblocks. So definitely bulls are in control here, but perhaps a correction would be in order. But once again, we just got this news, and US traders just got back to their desks from the long weekend. So we're going to have to monitor the situation and see what to expect from here on. We're already 2 minutes into the US session, so let's go to the Nasdaq. The Nasdaq 100 did not react much to Friday's NFPs and has been consolidating its recent gains over the past few days at the edge of the daily Ichimoku cloud, as you can see on the chart. This sustains risk for a pullback again that could test the 200 period EMA at around 15,200. Close below would threaten the bullish bias, but the downside is well protected. We have talked about multiple support levels from the daily Ichimoku cloud to the Fibo levels and the ascending trend line here. Prospects for another hold by the Fed and market expectations that it's done hiking continue to support this year's rally, and bulls are definitely in control and on the road to set new 2023 highs, current at 15,946, but the record ones at 16,770 are still distant. So let's talk about what's ahead. We expect US factory orders at the top of the hour, and then PMIs from the US on Wednesday. Wednesday is a very busy day. We already talked about Australia and how we expect the Q2 GDP figures on Wednesday. We said that there's below trend growth at this stage. So it will be interesting to see the updated figures. And of course, we also have another central bank, the one of Canada, again on Wednesday. The BOC comes from 2 straight rate hikes. It had offered no guidance, but expressed concern that inflation progress towards the 2% target could stall. And they also raised their CPI forecast for the year and the next. So there's definitely room for more hikes. And inflation picked up in July. On the other hand, the economy contracted in the second quarter. And so this may cause officials to stay on the sidelines. We're going to have to wait and see. But again, we've said it before, non-committal stance, data dependency, and transitional period for central banks creates high uncertainty about the policy outlook we're in a clutch period, in a transition period, and we're going to have to wait and see what the BOC and the rest of the banks over the following weeks will do. That's pretty much it from me. Thank you for joining me. We'll talk again on Thursday at our usual time slot, 10 minutes before Wall Street opens.